unlike QuantumScape, many of the hypergrowth companies that we discuss, have had meaningful and rapidly growing revenue, yet their stock prices have, for lack of a better term, been crushed. Now,
Right.
I know that you've been doing some interesting research on this, and I'm curious if you can share just a little bit about what you're finding without kind of giving too much about some of the behind the scenes stuff that you do.
Sure, Aaron. Yeah, so I'm glad you brought this up. This has been a huge area of research for my team and myself over the past several months, actually. It's been the focus of our research, I would say. And it centers around this very core and simple, almost too simple idea that the stock price of a company is ultimately determined by how successful that company is. Sounds like a very simple, very elementary, almost rudimentary idea, yet it is 100% true. And how well a company is doing is determined by how much revenue it produces and how much profit it produces out of those revenues. Now, the mathematical backing there is that if you were to pull up a chart of the S&P 500's revenue per share and the S&P 500 over the past 30 years, and pull up another chart with the S&P 500 earnings per share, and line that up with the S&P 500 over the past 30 years as well. Pull those two charts up, and you're going to see that the correlations are so strong. Mathematically speaking, the correlation between earnings and stock prices is 0.93, and the correlation between revenues and stock prices is 0.88. Now, this is going on data back to 1990, I believe. So we have 30 years of data here that's showing us that the correlation basically between revenues and earnings and stock prices is about 0.9. Now, for those who need a little statistics 101 refresher, correlations range from -1, perfectly anti-correlated, to +1, perfectly positively correlated. And you don't get readings close to +1, 0.95, 0.93, 0.9, 0.88. You don't get readings like that all that often in the real world. Perfectly positive correlations normally reserved for lab tests, things that happen in controlled environments. So for us to be seeing a reading of 0.9, a correlation of 0.9 between revenues and earnings and stock prices in the real world basically means that that correlation is as strong as anything gets in the real world. In a stochastic environment, that's as strong as a correlation as you'll find. So that's the basic, simple idea. As go revenues and earnings, so go stocks. Stocks should follow the trajectory of revenues and earnings. And they do. Every once in a while, though, you get this freak phenomenon where the stock price diverges from the revenue trend line, from this fundamental business trend line, from the revenue trend line, from the earnings trend line, wherein revenues and earnings of a company continue to move higher, yet the stock price goes lower. And that opens up what we're calling divergence windows. Because what happens is that this divergence emerges, and it's like stretching a rubber band. So the rubber band, it's super tight here, and then you stretch it, and you stretch it, and you stretch it, and you stretch it. At some point, you stretch your rubber band so far that it just snaps back, and it comes back to equilibrium, to its natural state. The equilibrium, the natural state of stocks, is to correlate with their earnings and revenue. So when this rubber band gets stretched, this divergence window opens up, eventually it reaches a point where the rubber band just snaps back. The stock price snaps back, and you see some enormous returns in these stocks amid these divergence windows. And that's the phenomenon we're starting to see emerge right now. That's only emerged about once a decade over the past 40 years. And every time it has emerged, it has created some tremendous buying opportunities. And we think we're seeing the same thing emerge today, because we're seeing a lot of companies continue to grow, to your point, revenues at a 20%, 30%, 40%, 50% year-over-year clip, quarter after quarter after quarter, yet the stocks are dropping. This is a huge divergence. It ultimately ends in one thing, a convergence. And in that convergence, the stock price will snap back up to the fundamental business trend line of the company, and that snapback those are windows where investors can make 100%, 200%, 300% in a matter of 12 months. And so long as those revenues continue to trend higher, these are the types of stocks that will be long-term compounders and rise 500, 600, 700% or more over the next few years. So it's a really interesting phenomenon we're seeing emerge, and one that we are hyper-focused on right now. Yeah.
So you talked about how this is something that has happened before, or in your analysis. Can you describe a little bit about the historical precedent that you've seen before and how that is trending with what you're seeing right now?
Yeah, great. Yeah. So what happens is that the markets are normally rational. And during rational times, the stocks are in equilibrium. They're in that natural state of following earnings and revenues. But every once in a while, something freaky happens, something scary, something spooky, and that causes the markets to act irrational. So when that irrationality happens, you break the equilibrium and stocks start to diverge from their natural state, from their earnings and revenue trend lines. This happened in the late 1980s during Black Monday, during the savings and loans crisis. You had a huge market crash. You had people thinking that the banking sector was on the brink of collapse. It was a very scary time. Recession fears were abound, yet companies continued to grow. So you had this divergence where revenues and earnings for a lot of companies were going higher and stock prices were drifting lower. It ended in a massive and rapid convergence wherein a handful of stocks rallied hundreds of percent within 12 months. Fast forward to the dot-com crash of 2000. You had people thinking that the internet was just a passing fad. You had people concerned about a recession. You had people concerned about also the Iraq war, and then the 9/11 attacks were happening around that time. So you had this divergence, because even amid all that chaos, companies were still growing their revenues and earnings, especially internet companies, especially dot-com companies. The revenues and earnings, Amazon, for example, eBay, for example, Microsoft, for example, they continued to grow the revenues and earnings through the chaos, yet their stock prices drifted because of macroeconomic fear. Eventually and inevitably, that divergence ended with a rapid convergence wherein stocks like Amazon and Microsoft and eBay rallied hundreds of percent within 12 months. It was a very, very rapid return window. Then you go forward, or fast forward to 2008, you saw the same thing happen again, where this divergence emerged. You had the great financial crisis, the housing bubble bursting. It looked like the American economy was literally on the brink of destruction. And what people don't realize is even through that noise, a lot of great software companies, a lot of great tech companies actually continue to grow their revenues and earnings, yet their stock prices drifted lower because of macroeconomic fears. Boom, divergence opened up. People who capitalized on that divergence window saw huge returns during the convergence. You saw massive returns during that. And again, you even saw this divergence happen, or divergence window open up very briefly during the COVID-19 crisis. Remember, March 2020, everything was falling out of bed. It felt like the whole entire stock market was just crashing, and the sky was falling down. But what happened? During that time, during March, during April, during May, a lot of tech companies, digital companies, really grew their earnings and revenues very quickly. So for a brief moment in time during March 2020, you had companies like Zoom and Peloton and Etsy that were actually growing their earnings and revenues very quickly while their stocks were falling out of bed. Huge divergence window opened up, and it resulted in a massive convergence over the course of the rest of 2020, wherein those stocks just absolutely roared higher. So this divergence window happens again and again and again and again and again and again and again, and it always creates massive opportunities. We think one is opening up right now. We're trying to study the best opportunities in it, see where the divergences are biggest, see where the opportunities are biggest. But that's something we're really excited about in the market today, because everyone's worried about a recession. Everyone's worried about inflation. Everyone's worried about the Fed, rising rates. People are worried about a housing top. These sound like very familiar concerns to what we heard in the late 1980s, what we heard in the early 2000s, what we heard in 2008. Not what we heard in 2020, because that was completely unique. This is not a world-ending pandemic. But it's very similar to concerns we heard during previous divergence windows. And so history doesn't repeat, it tends to rhyme. and we're hearing a rhyme right now. And so when we start hearing this rhyme, we start looking for opportunities. We're starting to find some selectively. We're still doing our research, but we think that over the next 2 to 3 months, you're going to get a great opportunity to buy some world-class stocks at really good prices right before they have this rubber band snapback convergence to their fundamental business trend lines.
Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.